Imagine that you're close friends with Steven Spielberg, having dinner at his New York penthouse, while he casually mentions how his foundation's investment returns have been absolutely incredible lately. Kevin Bacon's there too, and he is similarly raving about his retirement portfolio's consistent performance through every market crash and boom. The conversation turns to money, as it always does among the wealthy, and they tell you they've got the absolute best investor in the world they'd like to hook you up with. His name is simply Bernie, and it seems like every wealthy person in New York bows at his feet, treating him like some kind of financial wizard who's cracked the code that eludes every other money manager on Wall Street. What your famous friends don't know is that they're about to introduce you to the architect of one of the largest financial frauds in human history, a man whose charm and credibility would ultimately destroy thousands of lives and steal $65 billion from people who trusted him with their most precious asset, their financial security. Therefore, in today's episode of Old Money Luxury, we explore how Bernie Madoff stole $65 billion and destroyed New York. On the 17th floor of the Lipstick Building in Manhattan, Bernard Lawrence Madoff commanded an empire built on $65 billion of stolen dreams. His investment firm processed 15% of all trading orders flowing through the New York Stock Exchange, making him one of the most trusted names on Wall Street. The Polish Jewish immigrant's son had transformed $5,000 in lifeguard savings into a financial dynasty that stretched from the exclusive country clubs of Palm Beach to the philanthropic salons of the Upper East Side. Madoff presented himself with the polished appearance of Wall Street royalty, while his wife, Ruth, adorned herself with jewelry and luxury goods that reflected their elevated status. The family maintained luxurious residences and properties that reflected decades of accumulated wealth, furnished with museum-quality art and antiques. Their collection of homes included properties in exclusive locations, each meticulously appointed with the finest furnishings money could buy. His yacht represented the pinnacle of maritime luxury, serving as a floating palace for entertaining the financial elite who entrusted him with their fortunes. The Madoff name appeared on donor plaques at Lincoln Center, Yeshiva University, and dozens of charitable organizations across New York City, cementing his status as both financial titan and philanthropic patriarch. Bernard served as chairman of the NASDAQ stock exchange, a position that elevated him to the highest echelons of American capitalism and granted him unparalleled credibility among institutional investors. His technology innovations revolutionized electronic trading. With major exchanges adopting computer systems, his firm had pioneered years before competitors understood their potential. The investment advisory business, housed on a separate floor from his legitimate market-making operations, managed assets for 4,800 clients who believed they had discovered the secret to consistent wealth generation. These clients included celebrities like Steven Spielberg, whose Wunderkinder Foundation trusted Madoff with substantial portions of their endowment. Hollywood executives like Jeffrey Katzenberg invested $20 million in the fund, while actors Kevin Bacon and Kira Sedgwick placed their retirement savings under Madoff's stewardship. Elie Wiesel's Foundation for Humanity entrusted $15,200,000 to the man they considered a financial genius. Hadassah, the Women's Zionist Organization of America, invested $90 million through Madoff's carefully cultivated network of trust. Yeshiva University committed $140 million to his investment strategy, believing they had found a reliable source of funding for Jewish education. The split-strike conversion strategy he described to clients promised annual returns between 10 and 12%, regardless of market conditions, a mathematical impossibility that somehow seemed plausible when explained by Wall Street's most respected figure. His brother Peter served as chief compliance officer, while sons Mark and Andrew held senior positions in the trading division, creating the appearance of a family business built on decades of legitimate success. Yet, beneath the marble floors and mahogany paneling of the Lipstick Building, a different kind of family business was operating according to rules that would have made Charles Ponzi himself envious. The name told the story Miodownik, honey cake, sweetness wrested from Polish earth by Bernie Madoff's great-grandfather Berek, who married Chaya Rivka in 1879 in the Shtetl of Radoshice. These small Jewish towns dotted the Polish countryside, self-contained worlds where Yiddish echoed through narrow streets, where the rabbi's word carried more weight than any distant czar's decree. David Solomon sailed into Ellis Island in 1907, the surname simplified to Madoff, easier for American tongues, the honey forgotten. By the time his son Ralph married Sylvia Muntner and settled in Queens during the 1920s, they were simply Americans with accents, carrying memories of places that would soon be erased. The borough offered what Poland's Shtetls never could, a future unbounded by pogroms and quotas. Ralph found work in the skilled trades, while Sylvia stretched every dollar with the efficiency born of genuine scarcity. Their son, Bernard Lawrence, entered the world on April 29, 1938, during a spring when Europe teetered on catastrophe. The Madoff family occupied a small apartment in Laurelton, where young Bernard learned that respectability required constant performance, and that appearances mattered more than most people admitted. The boy displayed an early fascination with numbers and an intuitive understanding of human psychology that would later serve him in ways his parents could never have imagined. Bernard attended Far Rockaway High School, where he met Ruth Alpen, a girl from a family that had achieved slightly higher social status than his own working-class roots. Their courtship unfolded against the backdrop of 1950s prosperity, when young Americans believed that hard work and clever thinking could overcome any obstacle. The couple married shortly after graduation, combining their modest savings and boundless ambitions. Bernard's early employment included lifeguarding at beaches where wealthy New Yorkers spent their summers, observing firsthand how the truly rich behaved and spoke about money. These summer jobs provided him with $5,000 in savings, a sum that represented months of careful budgeting. In 1960, the 22-year-old Bernard established Bernard L. Madoff Investment Securities, LLC, initially operating from a small office where he traded penny stocks for clients who trusted his confident demeanor more than his limited experience. His early business model focused on legitimate market-making activities, matching buyers and sellers of smaller stocks that larger firms considered beneath their attention. The young firm's success grew steadily throughout the 1960s, as Bernard demonstrated genuine talent for understanding market inefficiencies. His brother, Peter, joined the business after completing his education, bringing compliance expertise and family loyalty to an operation that prided itself on ethical dealing. The Madoff brothers built their reputation through meticulous attention to customer service and technological innovation, investing profits in computer systems that gave them advantages over competitors still relying on paper-based trading. By the early 1970s, Bernard L. Madoff Investment Securities had become a respected name among institutional investors. The firm's growth paralleled Bernard's evolution from working-class immigrant son to Wall Street insider, a transformation that required abandoning certain principles his parents had taught him about honest work. Bernard Madoff understood that technology would determine who survived and who perished in the coming transformation of American finance. While competitors clung to paper certificates and telephone orders, he invested every available dollar in computer systems that could execute trades faster than human reflexes allowed. His firm's technological innovations caught the attention of NASDAQ officials, who recognized that electronic trading represented the future of securities markets. The computer trading software developed with his brother Peter became the foundation for NASDAQ's electronic systems, establishing the Madoff name as synonymous with innovation. By the 1990s, Bernard L. Madoff Investment Securities processed 10 to 15% of all New York Stock Exchange trading orders. The firm's success earned Bernard appointment as chairman of the NASDAQ Stock Exchange during the early 1990s, a position that elevated him to the pinnacle of Wall Street respectability. His legitimate market-making business generated substantial profits by matching buyers and sellers of stocks, providing essential liquidity services that institutional investors valued. The firm's reputation attracted pension funds, insurance companies, and investment managers who needed dependable partners. However, Bernard had quietly established a second business within his firm during the 1970s, an asset management operation that operated according to different rules than his public-facing brokerage unit. This secretive division began when Bernard started concealing trading losses rather than reporting them to clients, a practice that initially seemed like temporary creative accounting. The asset management arm marketed a sophisticated investment strategy called the split strike conversion approach, which supposedly involved owning 30 to 35 S&P 100 stocks while simultaneously selling call options and buying put options. Bernard described this strategy to potential clients as a conservative method for generating consistent returns regardless of market conditions, promising annual profits between 8 and 18%. During more recent years, he refined his pitch to emphasize returns in the 10 to 12% range, figures that seemed reasonable to investors familiar with mutual fund performance. The strategy's apparent sophistication impressed wealthy individuals and institutional investors who appreciated Bernard's detailed explanations of options trading and risk management techniques. His client presentations included elaborate charts and graphs demonstrating how the split strike conversion method had performed during various market cycles, providing reassurance that their investments were managed scientifically. The expansion of this asset management business accelerated during the 1990s as Bernard leveraged his NASDAQ chairman credentials to attract clients who viewed him as Wall Street's most trustworthy innovator. His dual business model allowed him to maintain the appearance of legitimate operations through his market-making activities while secretly operating the asset management division according to entirely different principles. Wealthy New Yorkers began referring friends and family members to Bernard's exclusive investment advisory services, creating a network of satisfied clients who vouched for his consistent performance. The combination of technological innovation, regulatory respect, and satisfied clients positioned Bernard Madoff as the financial industry's most successful entrepreneur, a reputation that would prove invaluable when questions began arising about his investment methods. What Bernard failed to recognize was that his growing reputation would attract investigators whose mathematical precision matched his own technological innovation. Harry Markopolos possessed the mathematical precision of a forensic accountant and the suspicious nature of a man who understood that consistent profits defied the laws of financial physics. Beginning in 1999, this independent investigator began submitting detailed reports to the Securities and Exchange Commission, arguing that Bernard Madoff's returns were mathematically impossible to achieve through legitimate trading. Markopolos provided the SEC with comprehensive analysis demonstrating that the split strike conversion strategy could never generate the consistent returns Madoff claimed. Yet his warnings vanished into bureaucratic indifference. The SEC received at least 6 substantive complaints between June 1992 and December 2008, each containing evidence that could have exposed the fraud decades before its eventual collapse. One particularly damning complaint submitted in 2005 carried the unambiguous title, "The world's largest hedge fund is a fraud." Yet, SEC investigators treated it as routine paperwork rather than urgent warning. Despite conducting 3 examinations and 2 investigations of Madoff's operations, the SEC never performed what their Inspector General later described as a thorough investigation. The agency assigned inexperienced staff who lacked understanding of options trading and Ponzi schemes, accepting Madoff's explanations without seeking independent verification. Meanwhile, Bernard expanded his client base through an intricate network of feeder funds that collected money from smaller investors and channeled it to his asset management operation. Fairfield Greenwich Group funneled $7.5 billion to Madoff, earning substantial fees. Kingate Management directed $3.5 billion to Bernard's fund, while Ascot Partners contributed $1.8 billion from wealthy clients seeking access to his exclusive services. J. Ezra Merkin earned management fees for steering investor capital to Madoff's operation, serving as a conduit between Bernard and institutional clients. These feeder fund arrangements allowed Bernard to maintain the appearance of selectivity while actually desperate for the constant flow of new money required to sustain his scheme. The Madoff family's involvement created additional legitimacy that impressed regulators and clients. Peter Madoff served as Chief Compliance Officer, responsible for monitoring all trading activities. Sons Mark and Andrew held senior positions in the firm's legitimate trading division. Shanna Madoff, Peter's daughter, worked as compliance officer from 1995 until 2008. Her marriage in 2007 to Eric Swanson, a former assistant director of the SEC's Office of Compliance Investigations and Examinations, created a personal connection between the Madoff family and financial regulators. The couple had originally met in 2003 when the SEC performed an examination of Madoff's firm, an investigation that completely missed the multi-billion-dollar fraud operating within the same building. This examination represented one instance when regulatory scrutiny could have exposed Bernard's scheme, yet investigators accepted surface-level explanations without probing deeper. The failure of both internal family oversight and external regulatory supervision created an environment where Bernard's fraud could metastasize from creative accounting into the largest financial crime in American history. The very success that protected Bernard from detection would soon transform into his greatest vulnerability when global markets began demanding something his empire could never deliver: actual cash. The autumn of 2008 brought financial apocalypse to Wall Street as Lehman Brothers collapsed and panic consumed markets worldwide. Wealthy investors who had previously praised Bernard Madoff's consistency now demanded immediate access to their supposedly safe investments. Withdrawal requests that had previously trickled into Bernard's offices suddenly transformed into a torrent that threatened to expose decades of deception. Client demands for $7 billion during November 2008 proved sufficient to trigger the collapse of his $65 billion empire. Bernard's Chase Manhattan bank account dwindled from $5 billion to just $234 million by late November. Each withdrawal forced Bernard to confront the impossibility of his situation, as he possessed no actual investments to liquidate. As December arrived, Bernard found himself trapped between mathematical certainty of exposure and psychological impossibility of confession. On December 10th, 2008, he gathered his sons Mark and Andrew in his Manhattan apartment to deliver the most devastating words of their lives. Bernard's voice cracked as he told his sons that his investment advisory business was finished, that he had absolutely nothing left. He described his entire operation as basically a giant Ponzi scheme, watching their faces transform from confusion to horror as they grasped the magnitude of his deception. Bernard estimated he owed clients approximately $50 billion, money that existed only on fabricated statements he had been generating for decades. He told Mark and Andrew that he planned to surrender to authorities within a week after distributing his remaining $200 million to selected employees, family and friends. The sons, who had spent their careers building the legitimate trading arm of their father's firm, suddenly realized they had been unwitting shields for history's largest financial fraud. Mark and Andrew left their father's apartment in shock, ultimately deciding they could not allow him to orchestrate his own surrender on his terms. Within hours, they contacted federal authorities, a decision that would destroy their father's freedom and fracture their family forever. Federal agents arrived at Bernard Madoff's penthouse at 8:30 on December 11th, less than 24 hours after his sons contacted authorities. The man who had once commanded respect as NASDAQ chairman answered the door in his pajamas, telling agents there was no innocent explanation. He was handcuffed and charged with securities fraud that would ultimately encompass 11 federal felonies. On March 12, 2009, Bernard stood before Judge Denny Chin in a packed courtroom and pleaded guilty to every charge without a plea bargain. He delivered a statement admitting that he operated a Ponzi scheme, betraying the trust of his clients. Judge Chin sentenced him on June 29, 2009, imposing the maximum 150 years in prison. The judge called Bernard's crimes extraordinarily evil, noting that he had betrayed investors, charities, and friends without remorse. Federal prison in Butner, North Carolina, became Bernard's final address, where he would die on April 14, 2021, at age 82. Peter Madoff pleaded guilty in June 2012 and received 10 years in prison for his role as Chief Compliance Officer. Mark Madoff hanged himself on December 11, 2010, exactly 2 years after his father's arrest. Andrew Madoff battled lymphoma, succumbing to cancer on September 3, 2014. Trustee Irving Picard recovered $14.7 billion through litigation. The Department of Justice distributed $4.3 billion to 40,000 victims worldwide. Bernard Madoff's name became synonymous with financial fraud, fundamentally altering how Americans viewed Wall Street expertise. Perhaps the most lasting legacy lies in the recognition that trust, once shattered by such comprehensive betrayal, requires generations to rebuild. And now, we'd love to see you in the comment. Is the Madoff scandal the worst fraud scam in history, or is there another one you think is even worse? We'll be looking forward to chatting with you below, and thanks for joining us for another episode of Old Money Luxury. Cheers.